Hi, this is Drew Tignanelli. This is our April update. It's always good to be here with you in person, Mikey, but I'm looking forward to not being here with you in person.
I think next time we'll be on the split screens. It's not because I don't smell right. Good, right?
It's because
it's because of the taxation of our state.
There's good news about that. We're going to talk about that in a little, but anyway, the markets are down a lot and then they've come back a lot. So we were down at one time 13%, I think, on the S&P, and now we're only down about 3%.
Yep.
So you've had a good recovery in the market, but that doesn't mean that you're not going to make another shot downward and try to test the low again. You just don't know.
We would be really, really rich if we had that crystal ball that we've been looking for.
We're not looking for a crystal ball. We know that just a good strategy long term as to what you're doing and why you're doing it is really the key to the markets. As long as you're diversified and nothing strange happens, no asteroid comes out and hits the earth and destroys mankind, nobody starts launching nuclear bombs,
right?
You're going to assume that markets are going to go down and they'll ultimately come back.
Yeah. So some of the things that we've been looking at in the markets, the Russia-Ukraine situation, while still ongoing and still terrible, shows a little bit of drop in momentum. So I think the markets are digesting that. The markets also went through a cycle where the Fed said, well, I'm going to raise rates. And then they said, well, yeah, we're going to start raising rates. And then they actually raised them a quarter point. So the market, has its strong reaction, and then it digests that information and goes, oh, okay, it went up a quarter.
And markets are thinking 6 months to a year ahead. So they know the Fed's planning to raise rates. They're anticipating how many they're already thinking they're going to raise it. And unless the Fed does something to surprise them to say, hey, what you were thinking is wrong, and that's rare. The market's usually right. That's the amazing thing about the market. And that's why most people can't predict what the market's going to do, is because they've already thought it out. And while you're seeing the things happening today, the market's 6 months ahead of you, already thinking about that. So,
well, and speaking of futures, and a topic that's on a lot of people's minds when they go to fill their tank, is oil. So oil is still high. It's off of its high price, so it's come down some, but it's still at a high elevated price. The good news is what we've said in the past is still true. The futures markets, looking ahead, still show an inverted curve for the price of future oil that is curving immediately. The very next month, prices are lower than the spot price today. 108 today, 107 next month, and then over the course of now to January, they steadily drop through to $90 a barrel. Now that's today's futures markets. Today that we're shooting this is 3:30:22. So for whatever numbers we share, they're the numbers we had this morning. But that shows us some things. As you had mentioned, S&P is down 3.6, NASDAQ's down 7.9, Dow's down 3.5. and the Russell growth is down about 10%. So markets haven't recovered fully, but they've, come back a little. Growth versus value, the growth stocks like Amazon is a growth, right?
Yeah, you could do that growth, Microsoft, Tesla, things like that, growth stocks,
versus the value stocks, Campbell's Soup,
Coca-Cola. I don't know Campbell's is anything.
You don't have Campbell's anything. Anyway, the growth led the market down. Growth went down worse than value did, but it's coming back up, and actually in the past few days to us shooting this video, it's starting to close the gap.
Yeah. So and we tend to be a little more growth oriented because we believe that the future is full of disruptor companies that are going to dramatically change the way life is, just like the airlines did 100 years ago, or airplanes did 100 years ago, I should say. But, it took like 70 years for airplanes to become commercialized. Nowadays, they come out with the technology, and within like 2, 3, 4, 5 years, it's commercialized, and so everything's moving faster.
Space got commercialized.
They're working on it in a big way, and it's amazing how fast everything's moving today. So anyway, I think that the markets are, doing what they do. They go down occasionally.
Well, and you had mentioned, kind of closing out our market segment of this, transports.
Transports are doing well this year. Actually, they're they're up. When I say transports, that means the airlines, the railroads, what else would be in there? Railroads and airlines.
Truckers.
Truckers, I'm sorry, that's a good one. And the truckers, I knew there was a third one. So, well, so they're doing well this year. They're actually up about 1% year to date. So
Yeah, that's always a good indicator.
it's a good indicator because it means that the transportation of goods and services is still moving along pretty well. And if you have an up market in the transport and then turn around and get an up market in the Dow Jones Industrial, that tends to be a very positive sign. That's actually called the Dow theory. Someday we'll talk about that. Anyway, let's move on to the planning topics.
Why don't you share what you alluded to at the beginning of the video?
Oh, yeah, that's a good thing. You know what I mean? Like the Maryland taxation.
Maryland taxation.
So Maryland claims, and I believe that this is a big, that it's going to finalize a bill that's going to eliminate taxation on single 65 years or older adults, or taxpayers, I should say, because I'm assuming somebody 65 is already an adult, right?
I met some that aren't. You know who you are.
Anyway, 65 or older taxpayers in Maryland who are single making less than $100,000 and married couples making less than $150,000, they're going to make their income 100% tax-free. Now, we have no idea what exactly that means,
right?
Exactly how they're going to implement it. There's talk about a phase-in. In other words, it doesn't happen today. You get a little bit this year, and then you get a little bit next year, and a little bit the year after that. And then also in 2027, it goes away, So they're supposedly using this surplus money they have from the coronavirus stuff, and they're going to use that to lower taxes. But since there's only a certain pool of it, it will only go for a certain period of time. And I guess that's the period of time they figured it'll go for.
Well, and I think the idea is that they get it through that period of time, and whoever's the governor, regardless of what party it is at that time, doesn't want to be the one that put the taxes back on the retirees and put the taxes back on
and so hopefully they'll extend it, or hopefully they'll make it permanent. And again, we don't know exactly what the law is going to read and how it looks, but at least it's good news. I mean, everybody thought it had a zero chance of passing when you consider lowering taxes in Maryland. But I guess since they have this surplus of money, they figure, what the heck, why don't we just use it for something and get people to like us again,
Yeah.
And so,
and it
is an election year.
Into an election.
So it'll be interesting to see what happens and how that works out.
So Drew, this time of year, for all of us doing tax returns or reviewing tax returns, it's one of those times of year that highlight the things that drive you nuts.
Yeah, because I'm looking at tax returns, and believe it or not, when I look at a tax return, I see more about you than you realize. I know exactly what bank accounts you're using. I know exactly, if you have brokerage accounts, where they are. I know where you're working. I know what you're putting away in your 401k, whether you have an HSA or not. I mean, the list goes on. I know which of the spouses is doing the medical insurance. You can all tell all this from just a tax return, right? And there are things that drive me crazy. And so we'll start off with one. People who are leaving large deposits in brick and mortar bank savings accounts like Bank of America, PNC,
Wells Fargo,
M&T, Wells Fargo. How do I know it? Well, when I see $10 of interest in Wells Fargo, okay, that's the equivalent of $100,000 sitting in there because they're paying 0.01%, right?
Right.
And so, and so $100,000 will make $10 of interest at 0.01%. That drives me crazy because Ally Bank would have given you $500 of interest. Now you might say, well, $500 of interest isn't that much, but a year or two ago, they gave you $2,000 of interest.
Think about the hourly rate on just opening an account and hitting an electronic transfer.
Right.
I mean, you're going to make at least, $400 an hour.
I mean, it's ridiculous. It's amazing. Just a little bit of time. And the beauty is you don't have to change your checking account. You don't have to change everything. You just keep the checking account. You do an online savings account. You ACH link it to it. One, like you say, it takes about a half hour.
I use American Express, and they have some sort of agreement with Charles Schwab, who's my bank, and I get that transfer happens immediately. There's no lag in it for me.
Wow, I mean, but even if there were, it's not a big deal.
Yep.
So, get rid of those savings accounts, keep your checking account at Bank of America, Wells Fargo if you want. And a lot of people will say, but if I don't have $2,000 in my account, I'm going to lose free checking. Well, then leave $2,000. Just don't leave $100,000 in there.
Right.
It drives me crazy. Get a home equity credit line. You don't want you to use it ever. I just want you to have it approved for it, because too many times clients call me up and say, hey, we're thinking about buying this house and I'm going to need 300,000. Can you get it out of my accounts for you? And I'm like, yeah, I can get it out of your accounts, but I have to sell everything and realize all these gains, et cetera, et cetera. And don't you have a home equity credit line that you can use? And then we can slowly figure out how to liquidate without causing you a major tax situation.
Right. Now, the one exception would be if you're planning on selling that property in less than 2 years, that may not be what you want to do.
Well, yes, if you have a house and you're already, you can't do the home equity credit line. But that's why I'm saying this.
Yeah,
You've got to
get
get the home equity credit line in advance before you come up with this idea that you want to move somewhere and sell your house and buy this new one, and you didn't get the home equity credit line in advance. Now I've got to disrupt your whole portfolio in order to do that. And it's so much easier if you just use, get it. It's free to get a home equity credit line, free to keep, and you only have to keep it in place for 2 years.
Yeah.
And that's something that everybody should be doing,
So what if I'm over 70 and a half and I'm charitably inclined, Drew? What's the thing that you want to make sure I don't miss?
What'd you tell me?
Well, I'm trying to tee you up.
I know you teed me up, but I'm teeing you
Also
up.
keep you along. We got to try to get this in 15 minutes. So qualified charitable distributions. If you're over the age of 70 and a half, or actually I guess 72, would that be more correct?
70 and a
70 and a
half.
half, you can still do it. Yeah. If
70
you're
and a
over the
half.
age of 70 and a half, and you're giving money to charities, you should be doing it through your IRA.
All of it. All
Any
of
of
your
your charity
charitable, except for like $50 here, $70 there, $25 there. Do that in cash, because they still give you a deduction for a few $100. But your big ones, a few $100, do it all through your IRA. This is so important. It is vital that you do this. If you're going to do it, and you're going to tell me later in the year, hey, I gave these charitable contributions and you didn't do a QCD, you probably hurt yourself, because it's probably being done with after-tax dollars under this current tax law.
Yep.
And so that means $1,000 gifted out of cash is going to cost you $1,000. $1,000 gifted out of your IRA is probably going to cost you $700.
Right. And there's little iterations to this. Currently this year, 1,000 in cash would cost you 400.
Yeah, but it's only if you did
1,000 in cash wouldn't have cost you, anyway.
Yeah, but if the client did $5,000 in charitable contributions and didn't tell us about it and didn't get it from their IRA, it cost them cost them $3,500.
Right.
I mean,
so get those QCDs in, and if possible, try to bunch them all together so that we can keep good track of it for you.
Yeah, I know you're rushing to get this 15 minutes in. So why don't we just leave the last couple ones as like a teaser for next month?
All right.
How's
next
that
month
good?
From Florida.
Next month from Florida, we'll be side by side on virtually.
Yep.
So anyway, I hope you all have a wonderful spring. This is Drew Tignanelli saying God bless.